So what does it mean for you here in the United States if Greece implements the bailout package, but the market doesn't buy it and keeps testing Greek and Italian bonds? Let's bring in Jim Awad. He's the managing director of Zephyr Management. Let's take a look at all these countries in Europe right now that are really in question. What is your take, Jim, in that scenario and what it means for us in this country?
Right. If the markets don't believe the Greek solution, they will immediately attack Italy, raise the interest rates in Italy. Italy could end up being a big problem. It could expand to Portugal and Spain. You will have a freeze-up, a financial freeze-up in Europe. You'll have a significant economic contraction. The financial system all over the world will have repercussions, and the United States will go from an economy that's growing to one that's not growing.
An economy that's not growing is not an economy that creates jobs. So when it comes to the jobs picture in the United States, what is that scenario playing out tell us about unemployment in this country?
Well, corporations with that kind of uncertainty would not increase their hiring. They have high profitability now, so they're likely not to start firing. But you would probably see a flat situation in terms of employment and the unemployment rate.
A big question mark is in a situation like that, how do you invest? Not just stocks. What do you do with bonds, even investments that you would view as more secure, T-bills here in the United States? What does this do to your investment portfolio?
Well, you have to be much more conservative. Don't forget the United States originally started this whole problem with our housing crisis. So what you would want to do is increase your bond exposure. You'd want to own corporate bonds and U.S. government bonds with a maturity of 5 years or less, a sprinkling of high-quality corporations with exposure to the emerging markets, which would still be growing modestly, and a few emerging market stocks, but a very higher proportion of your money in bonds.
Of course, that differs a bit depending on your age and your risk tolerance. Corporations. How do global corporations fare in an environment like this? What happens to their earnings?
Well, the situation in Europe would be really pretty bad, and you would probably go to no growth in the United States, 4 to 5% growth in the emerging markets. That probably leaves you with corporate profits being flat in the United States in 2012.